if you keep interest rates low enough for long enough, you will eventually get the economy going again. But you will only do it in a way which creates very significant inequality, because it works through stimulating a growth of equity prices or bond prices, which is good for the owners of wealth. And ultimately, it only really works by re-stimulating the very thing that got us into this mess in the first place, which is too much borrowing. If you try to re-stimulate the economy by just relying on very low interest rates, it's like curing a hangover with a very stiff drink.
Not so very long ago, I had Ben Bernanke in this studio, and I said to him, there are people who believe that the most effective way of reviving the US economy wouldn't have been all this quantitative easing. It would have actually been giving, say, $1,000 or $5,000 to every single citizen in the United States, because that way you would really stimulate the real economy immediately. He poo-pooed it and said that's ridiculous. He said nobody believes that anymore, and it turns out you do.
Well, of course, I believe what Ben Bernanke believed in 2003, because Ben Bernanke, again, in 2003, specifically in relation to Japan, very specifically said that what Japan should do was a tax cut or a public expenditure increase overtly financed by a permanent increase in the central bank balance sheet. That's what gave him the name Helicopter Ben at the time. I think what happened, and actually Ben talks about this in his book, he was so shocked by the fact that then he was bombarded as being irresponsible that he shut up about it later. But I think he was right. And I think actually if we had considered using direct fiscal stimulus funded with permanent money, we would have got out of this low inflation faster and with less long-term risks. I think the way that we've done it has actually been harmful for the long-term stability of the global economy.
You seem to be suggesting that today's generation of central bankers, and I'm thinking in this country of Mark Carney, that they're wrong, because Mark Carney addressed this notion of, well, it actually was people's quantitative easing he was addressing because the opposition Labour Party is pushing that. But essentially, it's still another way of sort of putting cash into the economy. He said it would imperil price stability, it would be inflationary, it would hit the poor and the elderly hardest. So you seem to be out of sync with
yes, I am. I think
orthodoxy in the central bank.
I think he's wrong on that. I mean, when you've decided to take a position against it, you say words like that. But I think Mark would accept that if you had a mechanism to make sure that you do it in a moderate and appropriate amount, there is no way it will produce excessive inflation. There is no piece of theory whatsoever that says that in technical terms it's impossible. It's absolutely technically possible to do a moderate amount of overt money finance, as I call it. The whole issue is whether you believe the political risks are too big, whether once you've broken the taboo, do you think we're bound to go to excess? That's the crux of the issue here.
Yes or